Good afternoon, everyone. We are a couple minutes away from launching this meeting regarding agency condo insurance requirements. We always try to start on time, so we are going to be starting on time today. We have hundreds of registrants for this particular webinar. That's not surprising with the changes that have come in the industry. So give us a couple of minutes, let everybody who wants to attend come into the room, and we'll start at exactly 1 p.m. Eastern. Thanks. For those of you who are just joining, we're just going to start in a minute or so. Try and start on time today. As always, I'm a stickler for starting these events on time. And it's 1 p.m. Ah, Thank you so much for everybody who's joined us. I'm sure we'll hear a couple of beeps as people start, continue to enter the room. We wanted to start this webinar today with really an acknowledgement and a thank you to all of the folks who joined and who have registered for this event. This is a really important topic in the industry right now. Agency condo insurance requirements, Fannie Mae and Freddie Mac's policies on insurance requirements have been tweaked, and there are some new guidelines that are coming out shortly that lenders are required to comply with. And we're going to go through a detailed overview of the most challenging requirements and the difficulties that currently exist in the mortgage world in having properties, condominium and cooperative properties, comply with the insurance requirements that are now required. Little cleanup at the beginning part of this call. We would love to hear your questions. We would ask you to put them in the chat. We will get back to every single individual. And what we typically do is we send one email out afterwards with all the questions answered, or we answer these questions individually if they're very, very, very specific and we don't think it's necessary for the whole group to have them. Somebody asked me about my vest the other day. I was like, I don't think we need to put that on the group chat to everybody, or the email to everybody. So we love to answer your questions. We do the best we can in order to do this kind of quickly and provide you with the answers with the guideline link. And our whole team comes together after these presentations and we go through this in detail. So important. We're going to try to answer all questions in part 2 of this presentation, which we'll discuss. When we were putting this together, we recognized that there's a lot of information to get through within 1 hour. There's detailed information on every single subject category regarding insurance that really has to be conveyed in a very specific manner because it's a unique part of residential mortgage lending for condominium cooperatives. So when we looked at the presentation, we said, wow, we can't get through everything within this 1 hour. So we're going to have one of our senior reviewers and analysts come on the call next time as well to answer these questions and really drill down into the policy much more deeply. Today is a really good overview of the current issues that exist in the industry and what the new policies are. So without further ado, today, by the way, today's seminar And today's webinar is really being presented by Lisa Geloso. We got lucky enough, or I got lucky enough to ask her to join this today. Lisa is head of product operation here and customer service here at CondoTek. And she is amazing. She can kind of recite these guidelines, give you an overview of what the agencies are looking for, and very importantly, how it's impacting the industry. So, Lisa, thanks for being on. I'm going to hand this over to you shortly. And pleasure to have you on this today.
Thank you.
So, sure. So, as most of you know, I think who've been involved with CondoTek, CondoTek is condominium cooperative data provider. There are several different products that we offer into the industry. We're an automated service, multiple resources. We're really providing an easy ordering process for our Condo Pack product and our Condo Project Warrant product. It's an incredibly high quality review that's provided back to our lender clients, which number more than 700 across the country right now. And it's consistent data, which doesn't always happen within the mortgage industry related to condominium and cooperative property documentation. We also provide a life of loan guarantee and warrant for our Condo Project Warrant product, where we warrant agency eligibility for condominium projects. So I think most of you already know that. The four services that we offer, these are some of the several services that we offer. Our Condo Pack Legacy product, we provide all the documentation to our clients. Our Co-op Pack product, which is exactly like our Condo Pack product for co-ops. Our Condo Project Warrant product, which is essentially our review solution for our lender clients. And we offer a full range of portfolio, Fannie Mae, Freddie Mac, and FHA and VA project approval services. So we work with a lot of new construction developers, existing established associations across the country, condo attorneys, folks that are in that space of ensuring that, or having a need for residential lending accessibility. And those products essentially are wide ranging because, we have some developer clients that need portfolio lending approval on new construction projects. And now with, the way the guidelines are, there are some homeowners associations that can only get portfolio or non-warrantable mortgage lending. And we work really hard and really diligently in order to provide them with global solutions for all purchasers or borrowers within any specific condominium or cooperative development. What we're really excited about right now is a new product which we started offering, which is our lending compliance report. This is kind of, been the culmination of years of requests from homeowners associations and property managers and attorneys across the industry, which they were all looking for a specific product outside of the lending process that would enable a homeowners association in order to get an analysis on their specific property and make a determination on whether or not that specific property was compliant with Fannie Mae, Freddie Mac, or portfolio lending guidelines. And, it's a difficult thing to do, right? You have to essentially align with the board, discuss the issues with the board, correct the problems, or provide the information so that the board can correct the issues that make a particular property non-compliant. And this is kind of taken off like gangbusters. We are getting requests throughout the industry from homeowners associations. And the goal for us is to create a more warrantable lending environment for our lender clients eventually, right? We want to get to these boards first and essentially outline what their issues are and correct them prior to any residential mortgage lending being applied for within those properties. So we're really excited about this service. And this is a new launch within the last 30 days, which we launched into the industry with astounding results, essentially of astounding interest from the industry in getting these lending compliance reports completed. So let's delve into it. Insurance compliance challenges. What's the current environment out there? What's going on? Well, There's a lot going on, right? There is a massively rising cost insurance environment out there, primarily the result of inflation. Um, we're seeing some properties seeing insurance increases from anywhere from 30% to, in some cases, 300% in the last 24 months. Massively increased policy premiums for these properties. God forbid you're in a specific state, we're going to go into geographic compliance, or God forbid your condo property or cooperative property is located near the water. We're seeing costs just rise at a pace which we've never seen before. And this is, of course, putting an enormous amount of pressure on not only the residential condominium cooperative boards, but on the property managers seeking insurance for these associations. And they're really not armed with the appropriate information about ensuring that these policies are compliant with residential lending guidelines. We're seeing that, it's kind of a slow process for them to understand how important it is for these properties to be compliant from an insurance perspective. And there are challenges there, right? We're seeing these costs rise so much that, they're doing whatever they can in order to mitigate that increase in cost. And that sometimes includes increasing their deductibles for any sort of loss or occurrence that would result in a loss. We've seen deductible increases that on an average property maybe were $100,000 per occurrence or $50,000 per occurrence, and now we're seeing deductible increases that are like they're $250,000, $500,000 deductibles. I mean, some insanity is going on out there, and rightly so. The agencies have want to limit what that maximum deductible is, um, and they've put some guardrails around that, and that's where we're seeing a major challenge with insurance right now. Obviously, if you increase your deductible, your insurance cost is less as an association, and that's one of the ways, obviously, that these property managers and boards are trying to mitigate this rising cost, but it doesn't always work. In fact, it rarely works. We're also seeing carriers completely declining policy continuation, right? We're seeing carriers that have insured the same condominium or cooperative development for the last 10 or 15 years, and all of a sudden in their yearly insurance review they've decided to provide insurance going forward. That's a major issue because not only does the homeowners association condominium cooperative have to go out and seek new insurance, but the new insurance offerings that are out there are typically not as good as the ones that they've had previously. And that's also a major cause of concern and cause of increase in cost for these associations. We're seeing that carriers are now requesting, in many instances, reserve studies, property condition analyses, engineering reports, just to provide an insurance policy. So that's a new wrinkle. What's interesting about that is that it's kind of a double-edged sword because, yes, carriers in many instances are requiring these reserve studies and engineering reports, but condominium properties who have amassed a substantial amount of reserves and who haven't had, major losses or, in the last 3 to 5 years, are often offered reduced insurance premiums as a result by proving that that property is in good mechanical, structural, and financial condition. So in many instances, an engineering report or a reserve study has helped condominium associations that have seen rising costs or while shopping their insurance policies. And in many instances, we've seen reductions across the industry from that perspective. But that's really a limited amount of properties, and that's properties that are in really good condition. Properties that have had a loss or have had, a ding on their insurance policy in the past or some sort of claim, are often offered policies at a much higher rate. This higher cost and increased deductibles, obviously they may not be compliant, but there's also other parts of the policy that are being changed or aren't compliant with, agency requirements. So actual cash value issues, guaranteed replacement costs, special form, all risk form, perils, changes to co-insurance that have happened in the industry, essentially by the agencies, which we'll delve into today, have caused, policies not to be compliant. Guaranteed replacement cost, again, actual cost value, inflation guard, an annual review requirement, there's in the availability of these insurance policies in the industry, or good data in the industry, I should say, about what's compliant and what's not, is really limited. So that's, again, the reason for this presentation today. And of course, the final reason, which we've seen problems with, insurance for these properties, has been geographic limitations. Properties in Florida or California, as an example, where we've seen massive issues with, insurers essentially and carriers fleeing the states because they've had so many claims, and state mandated or owned insurance firms kind of popping up and being the only area of coverage for condominium or cooperative properties at exorbitant insurance rates has become pretty common. And unfortunately, we kind of see that continuing. We see that continuing in several other states who maybe haven't, gotten to this place yet, or where insurers are essentially recasting their policy requirements based upon their loss runs. So it's a very changed environment right now, and we believe that it's going to continue to change as a result of insurers not providing policies in specific geographic locations. So that all being said, we're going to delve directly into the issues, right? And Lisa's going to provide a outline of what the issue is and what you're seeing as a lender or what you're seeing as a property manager, and why these policies are not compliant or may not be compliant, and what you have to look for when you're reviewing a policy. So Lisa, without further ado, after all of that, let's go over the GSE clarifications that are effective on June 1st of this year.
Okay, thank you. Good afternoon, everyone. Thank you for attending today. So just to piggyback off of what Orest said, we're going to go over the what today in part one. Part two will be our senior vice president, our vice president of risk and compliance, to talk more about the what. So as we go through the what is now, what is happening now, and what is applicable to guideline, please be sure to pop your questions into the chat so we can collect them and then answer them appropriately, either via email, and we will be addressing them in our part two as well. So the changes and the what's when we speak about GSE requirements is actual cash value. Actual cash value was never acceptable. The GSEs have come out to define and clarify that it is currently unacceptable, and that a policy that limits or depreciates or reduces or otherwise settles a loss in any other way, it's not acceptable. We are seeing a lot of policies come through written to actual cash value, or parts of it are written to actual cash value, and it is according to the GSEs, it is a no-go. Lenders and services are also responsible for verifying that the coverage amounts meets the GSE requirements as of the current insurance policy effective dates. So you have to be looking at those effective dates. Minimum required perils that a policy must cover are those found in the commercial broad coverage form. It's really broad plus, not broad minus, meaning that the listed required perils, you can find them on the GSE's website under their master insurance policies. They have to meet the minimum requirements. co-insurance requirements have been removed, as well as all the references to guaranteed replacement cost, ERC and RC coverage. Basically, we believe that the agencies found it was too confusing and that they simplified it, that replacement cost has to be 100% across the board. Just waiting for the next slide.
Yeah, I got a question though. So do you think that based upon the co-insurance requirement, the new co-insurance requirements or the new kind of change in the policy, that we will see more condominium and cooperative developments be acceptable with their co-insurance, that they currently have in place, or less? Like, what's your gut on that?
My gut is 50-50. I mean, the current policies, we still see policies coming over with co-insurance. Or we're asking for proof of 100% replacement cost, and we're getting all kinds of answers other than what we need to prove that there's 100% RC in place. So it's really important that you implicitly ask them to make sure that the policy is 100% replacement cost across the board.
It's so surprising that we're getting everything else except what we really need on a review. So surprising. All right, that's my joke for the day. Actual cash value, Lisa.
Yeah, so as I discussed before, that the claims must be settled on a replacement cost basis, and the policies that have any kind of actual cash basis, limit, depreciate, reduce, or otherwise settle, they're not eligible.
Replacement cost?
So again, as previously discussed, the master policy has to be at least equal to 100% of the replacement cost value of the project's improvements, including your common elements, your res structures, and the current, as of the current insurance policy effective date. So if you have a policy that has 80% co-insurance with nothing else, and there's that 20% deficit, that is ineligible.
Yep. Perils and broad form coverage. This one has been hitting us left and right, correct?
Yeah, so I mentioned previously it's broad plus, not broad minus, and usually special form covers that. So all the required perils, again, you can find the list of the required perils per GSC on their website. You also have to make sure that there are no exclusions. So if you think you're getting a special form, you have to make sure that there's no wind excluded, and there's not a special wind policy that you have to ask for and then research to make sure that that's compliant and well as well.
Yeah, so let's pause there for a second, because one of the ways that insurance costs are reduced, and just to kind of really fully formulate what the issues are with the industry. And again, I went over, the rising cost of insurance. When you see exclusions, those exclusions are in the policy either because A, their new insurance carrier didn't offer that insurance, or B, that they're trying to reduce their insurance cost in any way possible. And maybe their broker or maybe their property manager got the idea that if they exclude this one, peril, that the insurance costs would be dropped so dramatically, and it's such an unlikelihood that that peril would occur. And well, guess what? That's not the case, and you can't do that. And that's where we've been finding more and more, when we see these new insurance policies that are coming over for these associations. And by the way, we're seeing a bunch of them, meaning that we're seeing, the same insurance policy in place for an HOA for, 5, 10, 15 years. All of a sudden, there's a new carrier that's on board coming up, that is providing, insurance to the property, and we're coming up with an additional review. That's why it's also so important to review insurance policies for projects regularly, right? We have seen in many instances where associations will change their policy, not at the end of the policy term, but in the middle of the term, because of some sort of reduced cost that they found out there in the industry. And that's become something that's I should say is becoming more popular. We used to get a year of a policy, right? A policy would be in place for a year. That's not always the case any longer. So if you reviewed something, in August, and it's, coming up for re-review, just double check that, loan or that project again, a policy, because it may have been changed mid-year. Really important.
Yeah, and I love all the questions that are coming in. And what we wanted to do is we wanted to spark the conversation. We want the questions. We want to talk about the what before we talk about the how and the why. And again, that's why we are moving to a part 2. So I love the questions. Keep them coming. Great questions. Great questions.
Co-insurance. Now, Lisa, you did delve into this at the beginning of the presentation, but let's jump into a little bit further.
Yeah, so the agencies have basically simplified kind of their explanation around the co-insurance, and they're, now just saying that the requirement for the policy coverage limit reference represents 100% of the estimated replacement cost of the project at a minimum. Generally, you can, as a lender or servicer, verify that coverage. It could be the property insurer, it could be an independent insurance risk, could also still be getting an RCE or an insurance risk appraisal. So those things still apply to see if you have 100% RC. And that's kind of where we're at with the 100% RC.
It's interesting because this guideline in and of itself, or this change, the policy in and of itself, may make some properties, condo and co-op properties across the country that have been non-warrantable for years kind of relook at their policies. There was an instance recently, got a call from a property here where I am in New York, where I live, that has been non-warrantable forever because of their insurance policy and because of their co-insurance. And it actually sparked the conversation again with the board and the property management firm to go back to their carriers and see if they could now rework their policy to become compliant, based upon 100% replacement cost. Not that it's a change that was so dramatic, but it was something that they kind of were able to look at and say, okay, you know what, we need to finally get warrantable. So the point there is, there have been properties that we've seen for years, and if we've all been, we're all in this industry, or most of us, I think, on this call. I saw the guest list, and in this industry for a very long time. And there are some properties out there that are finally making some changes to their insurance policies, circling around co-insurance. So take a look, go back to some of these properties that that you weren't able to provide residential mortgage financing in, and go back to them to see if you finally can.
I see a lot of questions coming in on the co-insurance, and a lot of what we do here at CondoTek, and I'm sure what a lot of underwriters do at your place, or the underwriters that are on the phone. It's delving into the master policy itself to look at what inclusions and exclusions there are if your insurer will not state what the value is. So co-insurance is a really big topic, and again, keep those questions coming in, because we're going to talk about this more in depth in our part 2.
And well, Lee, hold on a second. But to your point, because I just want to get your opinion on something here. We really spend an enormous amount of time delving into those master policies, right? And not only acquiring them, getting them in our hands, and seeking to see if they are compliant, and making a case for every single association. And you and I have joked before about, that we're the we try and resuscitate every single condominium or cooperative development to get it to compliance, and sitting there on top of it with our hands kind of pounding on its chest, right? That's our analogy internally. So, with that in mind, have you seen a lot of reluctance in providing master policies in the industry. I know we have, really kind of honed our skills in getting a copy of those master policies, but it's not always the case, right?
Yeah, some won't release it without the permission of the HOA. I mean, agreeably so. And some just say, I'm not going to answer any of your questions. Have at it. And we get a 500-page policy.
Yeah, we love those. We love when that happens.
Yeah.
Yeah. So anyway, the point being is, we've spent a lot of time kind of honing our skills in not only the review of those master policies, but acquiring those master policies. And it's kind of a takeaway for the lenders on this call. Ask for them on day one, because in almost every single instance, you will need to verify the information that's in them. I know a lot of lenders rely on the questionnaire and the information that they get from the insurer, but it's not always accurate, we found as well. Inflation guard, Lee.
So Inflation Guard is an endorsement that is required for both GSEs. I get a lot of questions from the lenders that we do service. I speak to sales a lot, and they're like, I never knew this existed. It's always existed. The reason why is particularly now, due to rising inflation, the cost of insurance to the association and the unit owners could substantially increase, particularly over the year. An inflation guard helps protect against the risks and surging insurance costs. However, the endorsement is required when it's available and applicable. So if you press the insurance agent and it's not available in the market area, you can document that and move on without the endorsement, but you really have to document that it's not available in the market area and it's not available for purchase. Because if it is available for purchase by the carrier and available to the HOA, it's a requirement that is needed for you to close and sell your loan. And basically, we're saying our solution is to educate the HOA that you're working with on why it's needed to sell your conforming conventional loan. And we have seen in a lot of cases that HOAs will often add this to their policy, not without board approval, but when you do go back to an HOA and you say, well, I have this project and it's non-compliant for these 1, 2, or 3 insurance issues, we have a lot of HOAs that are willing to make that right. You have to be able to be armed with the information to speak to the HOA in order to explain to them why it's necessary and why they need to make this change, because ultimately it will be a small increase to their policy premiums.
Well, right there, right? That's, I think, one of the biggest points, and a review of a condominium or cooperative's insurance policy is so important right now. Based upon even this one topic, right? Inflation guard. This is a minimal cost for an HOA or a condominium association or cooperative association. And I'm talking really minimal. I mean, less than $1,000, sometimes, a lot less. It's not a major increase to their insurance cost, and it is something that's required right now. So the review and analysis of a master insurance policy is so important, and to get boards on the same page and property managers on the same page. I have to tell you, we have been doing webinar after webinar in order, directly to condominium cooperative boards and property managers, just to inform them, just so they are aware. And the other point here that is really important to make is that not all property managers, and certainly not all board members, are experts in insurance. So to Lisa's point, you must provide them with the data, the guideline, and explain to them what inflation guard is, why it's necessary, and also outline that it's such a minimal cost. Not only is the borrower who's applying for a mortgage in that particular property going to, benefit because they're going to get their mortgage, but all future borrowers, including the current owners in the building and residents in the building, should they refinance, benefit from that policy being changed. So incredibly important to understand. Deductibles. Here's my, this is what I started with, Lisa. Can you go through this, please?
Yeah, so the Condominium Homeowners Association policy deductible for fire, water not caused by flooding or wind damage to the insured improvements may not exceed 5% of the limit maintained for the building. That's it. There is a 5% cap on your deductibles bottom line. When you're in a per unit, when you have a per unit deductible, if it is for a named peril to a specific geographic area, and that is getting that out of the insurer, is this peril specific to this geographic area? It's still eligible for sale if the unit is covered by the borrower's HO6. It's the same thing if you have multiple occurrence deductibles. No more than a single occurrence can be greater than 5%. It's really simple math. So 5% for the policy overall deductible, but when it's a per unit deductible, you really need to read that COI to see if it's a per unit deductible. And if it's over the 5%, we have to go back to the insurer and we have to see if it's specific to a geographic area, whether it's go ahead. I'm sorry.
Yeah, I was wanted to let you finish, of course, but I wanted to pause for a second because, first of all, I got in a little bit of trouble. In one of the last presentations we provided, I said that you couldn't cure an insurance issue with an HO6 policy, and I kind of got my hand slapped a little bit and had to put out a retraction of that statement, because there are instances where you can cure an insurance issue like this on deductibles with an HO6 policy. But they're limited, and it's really important to understand. So that whole second bullet that's here, there are limited occurrences of HO6 policies being changed in order to get an insurance policy compliant.
This is true.
That correct? Right? It's not all over the place. I mean, it's limited areas where they can actually do this in, correct?
Yes. It depends if they have a 5% per unit deductible for volcanic action, but they're not in a geographical specific area for repeated volcanic eruptions. But they have the deductible for some reason. It's really getting with the insurer to understand why, and is it or is it not specific to that geo area?
Yeah, it's so I know I got my hand slapped on this one pretty hard about not saying that this was available in the industry, and it doesn't always happen where I make a mistake, but I made a mistake on this one. But I do want to recount that and restate that. Look, it's so limited that I didn't feel like we had to kind of outline it, but it does happen from time to time, and in certain instances where you do have that per unit deductible. The other point to make here is this goes back to my initial outline that I provided at the beginning of this webinar, which was, this 5% issue is coming up more often than you think it would come up, specifically because of the rising insurance cost, right? We're seeing that there are so many associations doing everything they can in order to reduce their insurance costs. And the first thing that happens is, they increase their deductible to more than 5%. So we're seeing a lot of policies out there that have exceeded the 5% deductible rule. And this is recent, right? This is in the last, I want to say, 6 months where we're, looking at this and seeing a trend in the industry that this is one of the ways that brokers are trying to cure these increases, and you just can't do it. So it's one of those things to look at very closely when you're reviewing. And really,
and I'm seeing in the comments that a lot of the of our friends on the phone here are seeing deductibles 10, 15, 20%. Yes, we are seeing that. We're seeing that as well.
Yep. by the way, that's a much more difficult cure for an insurance policy. Because if you redo, let's say if you do have a 10, 15, 20% deductible, and in order for the property to be compliant, you have to back that down to 5%, the difference in insurance costs for the homeowners association, for the condo or the co-op is astronomical in some instances. We've seen 100,000, 200,000, $400,000 increases per year based, dependent upon the size of the property, by reducing that deductible. That's why they did it in the first place. So that is a much more, in many instances, it's a much harder issue to cure than you would originally think, because if you reduce your deductible from 10% to 5%, sounds like an easy fix. Unfortunately, the cost increase bars a lot of associations from doing that. So really important to understand. Flood insurance.
So the flood insurance slide, and maybe one or other two slides are just a reiteration that the GSEs have come together to mirror each other in requirements, which I think is awesome.
Yep.
Nothing's really changed, but I do really want to go over the third bullet point, but I will go over everything else. So they must, if they're in a flood zone, they have to have flood insurance. It's 80% of the building's replacement cost, or the maximum coverage amount from the NFIP per unit. Both agencies have a caveat that if there are contents in the building, the contents coverage must be available. So lots of times we will get that there is no contents coverage, but we have content such as cameras and things, expensive furniture and artwork that are in that common area. You must get the cost of the contents, and then the contents coverage for the flood must cover that actual cash value. We do see a lot of kickbacks on the contents coverage, and a lot of our ops folks and a lot of our sales folks didn't even know that was a thing. So we wanted to highlight that contents coverage on the building is a thing. It's needed. And basically, when it's there, we'll go back, we'll find out the cash value of the contents, and we'll make sure that there's enough flood coverage to cover that. Sometimes there's, just a hallway with nothing in it, and therefore contents coverage would not make sense. But when there's a shared area with things that have a good cash value to them, they need to be covered.
So really, really important kind of addition to this, to what you outlined here is we love when we get really good reserve studies to review along with our package. And the reason why is when, it's funny, when you're reviewing insurance, in a good reserve study, and some states require reserve studies, and there's actually a new requirement that just came out in New Jersey at the beginning of this year that every single property in New Jersey, every condo property, is going to be required to get a reserve study by 2025, by January 2025. And frankly, we love it. And the reason why we love it is very clearly outlined within a good reserve study. You will see FF&E, furniture, fixtures, and equipment, and it outlines exactly where it is within the building and what the actual cost of that FF&E is, which in many instances gives us an ability essentially to get these flood insurance coverages accurately aligned. So there, again, we go to so many places when we're doing one of our condo project warrant reviews, or a lending compliance analysis on a project, that we will pull data from all of these different sources, which we know a lot of our friends in the industry that are on this call do as well. But it's a great place to look for the cost of contents in a specific condominium or cooperative property. Very important to know. Anything else on this, Lisa?
No.
Okay. Whoops. special coverage requirement for project developments, building ordinance or law coverage. Now we get a lot of questions about building ordinance or law, correct?
Well, yeah, so we'll get building ordinance and law back, and it's only A and B and not C. It's all three parts that are needed. But another important thing, like inflation guard, the coverage is not required if it's not obtainable in the insurance market available to the association. It's a simple call to the insurer to find out if it's available in the market by the carrier. So again, your building ordinance and law needs to be all three parts. There is an out if it's not required. And then on your boiler, machinery, and equipment breakdown coverage, just reviewing with everyone that if there is central heating and cooling, that the minimum is 2 mil, or the replacement value of the building's housing and or boiler machinery.
Again, go ahead.
I was just going to say, building ordinance and laws, it's all three parts that are needed. Sometimes, well, lots of times we have insurers come back that they only have a piece of it. And a piece of it is not good unless it is accompanied by a statement from the insurer that it is not obtainable in the market area.
So again, we love the fact that we're seeing such a prevalence of reserve studies being required across the industry. We can find boiler and machinery cost or essential heating and cooling cost based upon the components in some of these really good reserve studies that are being created that we've reviewed in the industry. So again, ask for it. If we're doing the condo project warrant, we're asking for it and we're reviewing it, but it is kind of like the secret trick to find certain things about a building which you would never know, namely being the machinery and equipment cost. Next. Whoa, not too fast, Lisa.
Orest, I just wanted to add, back in the day, I had a very dear friend at one of the GSEs that was in auditing, and I was learning and I was young, and she said, if you as an underwriter don't know and submit and sell to us without a clear story, we don't know.
Yeah. It's such an important point. The thing of it is, and what we've seen with a lot of these new guidelines, and I've said it many times before in the presentations that I've provided, and we all have the same kind of philosophy at CondoTek, which is we really like a lot of the new guidelines that have come out. We really think they're really important for the industry. There are a lot of residential owners in condominium units that frankly have gotten screwed as a result of these guidelines not being in place over the last decade or two. We're in many instances we're lucky enough not to see the repercussions of that, but the agencies do, right? The agency sees when a specific loan goes into default because they didn't have the appropriate insurance coverage in the building, and you're displacing 15, 20, 50 unit owners in a specific building. So my caveat in all these presentations is we really like these guidelines that are coming out, and we think that the agencies and GSEs are really being thoughtful about how to about how these guidelines come out and what they're actually doing in order to ensure the safety of each and every one of these condo and cooperative buildings. So that being said, look, we really need to delve into this topic deeply. And what we wanted to do today is provide you with this outline. You're all going to get an invitation to part 2 of this presentation, where you're going to pull in Dan Cerullo and have him opine on not only the policies but also answer some of these questions that you've written in the chat today. And Dan is one of these brilliant minds in the industry, and Lisa and I work with Dan on a regular basis here, and getting his legal review or his legal analysis, on a particular property, and because of his legal background and because of his employment here over the last decade or so. I forgot how long he's working here. It's been really nice to have him on, and we want to be able to provide you with that access to Dan. Some of you on this presentation have already spoken to Dan in one capacity or another, or seen his review. If you're an attorney who's on this presentation, you've likely asked Dan a question about, a new construction condominium development, or how your HOA should, formulate their notification provisions within their operating documents. He's literally one of the most brilliant minds in this industry, and we're lucky enough to have him on board. So I'm selling that pretty hard because it's pretty important for him. If you want to ask some great questions or get some great answers, please join us on April 10th, which is the date we're going to have part 2 of this presentation. We also put it out a couple of weeks because of the holidays that are coming up, but also because we really want you to kind of mull over this presentation, which we will send to you, and ask any additional questions you have, and give you enough of a time frame so you can look at a project that you're currently reviewing and see an issue and ask a question about it. Lisa and Dan and I are always available for our clients. We're happy to answer emails, and happy to answer questions, about a specific policy or review whenever we can. There's limited time within every single day, but we try and do it relatively quickly. So please reach out to us if you have a specific question. Otherwise, that's urgent. Otherwise, we will answer these questions that you've provided us with today shortly, and you will get an answer to all the questions and a registration link for this part 2 of this presentation. Here's our contact information. You're going to get a copy of this presentation, so you'll have that link as well. I think most of the folks on this presentation know us already, and our disclaimer. So without anything else being said, and thank you so much for joining today. I should say with that, I wanted to make sure today that you had a really good understanding of the policies and get you access to Lisa, who is, my guru in condominium lending and cooperative lending policy, and we often work together to kind of solve problems at the company. So thank you very much, and hopefully you'll join us in a couple of weeks. And somebody asked the question, will I be at the MBA conference? And yes, I will. I'll be there. I think it's in July. The notification just went out. So yes, I will be at that MBA conference. Hope to see everybody who's there.
Thank you, everybody.
Thanks, everyone.